Success in Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome back to the Financial Survival Network. I'm Kerry Lutz, and we're really pleased to have Alan M. Newman back on. You know him well. He's the editor of Crosscurrents, a fellow New Yorker. He's had a varied history of different careers like yours truly, acting, computer programming, game design, real estate, and he's a Long Islander. And now he's been writing a newsletter for quite a while, Alan M. Newman's Stock Market Crosscurrents. And Alan, welcome back.
Thank you very much for inviting me back on, Kerry.
Hey, so this market, it's totally counterintuitive. It just seems to be totally divorced or disconnected from the so-called real economy. And it makes one wonder, how much longer can it keep on going its merry way?
Well, my answer would be not much longer, and I would describe the market in one word: dangerous, quote, end quote, dangerous. As you well know, leverage is just at ridiculous levels. Margin debt is over $500 billion now. That has never happened before. We've had 4 huge peaks in history. One was in 1929. Frankly, that peak will never be equaled again. I mean, there's just no way. But, you know, you could buy stocks for 10 cents down on the dollar in those days. That's never going to happen again. But the other peaks were the year 2000, where margin debt got up to 2.5% versus GDP. 2007, where we were close to that level. And now we're up to 3% of GDP, margin debt versus GDP. We haven't seen that again since 1929. And I believe that this top is as big as the ones in 1929, 2000, and 2007. It's a historic top. I can't give you a day on which it's going to turn around, but certainly the market's unfavorable season is about to begin. We have what I like to call the dead zone that begins at the end of April. It's the old adage, sell in May and go away. And if you go back to 1950, that 6-month period from May through October has actually resulted in a loss of money. If you invested just solely in that period, you lost money. So the market's entire gains over time have come through the good 6 months. What's very interesting to note is since 2000, the pattern has actually changed a little bit. And you won't hear this in the financial media. You won't hear this on CNBC. The dead zone is actually extended out to December. If you invested money from May through December, you lost. Whatever gains we had came in just 4 months: January, February, March, and April. January and April are significant because that's where mutual fund inflows are the greatest. They actually spike in those 2 months. Those 2 months together are very significant. They account for about $3 out of every $8 in mutual fund inflows. And you have net outflows from May through December. What worries me most, though, again, is getting back to leverage. You see it not only in margin debt, but you see it with consumers, how they are tied up. Student loan debt is now over $1 trillion. That's just a crazy number. We see it with our major banking institutions. Derivatives outstanding just go up and up and up every year. We're talking about $240 trillion. That's a lot of zeros. And if you take a look at the list of assets of these major banks and the amount of derivatives they have, not that derivative equals debt, it doesn't, but in many ways they equal a bet. And even though some of these bets offset, you're talking about a worst-case scenario where, just for the sake of argument, you have a company like J.P. Morgan Chase. They have $70 trillion in notional values of derivatives. If only 1% of that was to cause a loss, it would pretty much wipe out J.P. Morgan Chase. Their derivatives are equal to about 35 times their net assets. In the case of Goldman Sachs, notional values in derivatives equals about 450 times their net assets. I don't know how we got into this predicament other than to say that these companies make money by putting together these contracts. They put together these packages, and they sell them to the public. They sell them to other brokers. They sell them to other institutions, such as pension funds. And, of course, this is how the debacle unfolded from 2007 to 2009. You had derivatives that just were put together to make money for the people that put them together. And another point to consider is with some of these derivatives, when there's a bet against the market or against a particular sector in the market, it could prove profitable for certain entities to try and manipulate that sector down in value. That certainly happened from 2007 to 2009.
So, hey, Alan, this year, the so-called January effect, the stock market was down, not a lot, but it came down in January. So that's a warning indicator as well, because like you said, funds, the mutual funds and other institutional investors generally hop back in January and cause the market to go up. So a further warning indicator there, right?
Right.
And then, like you said, the over-leveraging of America, from college student loans to credit card debt. We saw it go up last month at record levels. And we see that retail stores are closing up at a record level. There's over 1 billion square feet of retail space available in the country, partly due to the internet e-commerce revolution, but also because people don't have the money to buy. And we've seen the return of subprime borrowers to the auto market, not a good sign. Channel stuffing in the auto market, where they've just overproduced vehicles and just dumped them on the dealers. And a lot of bad signs in the economy ahead, right?
Yeah, I have 4 good-sized malls near where I live. And I'm at a particularly vibrant area of nice Nassau County.
I know it well.
I'm sorry?
I know it well.
Okay. Yet 2 of those malls, one of them is almost completely empty, and the other one is struggling. Granted, Roosevelt Field is doing great. It's the 4th largest mall in the country. It's upscale. So you do have a lot of shoppers constantly in that mall, but the other ones are all, they're trying to compete, and they're kind of failing. You raised the point about the internet, and it is a very big factor. Bricks and mortar is just crumbling all around you. We've seen a number of store closings. I think Radio Shack they're talking about 1,100 stores closing. Best Buy, I've mentioned them in my analysis several times that they may be going the route of Circuit City at some point in the future. You have a society where people go into Best Buy, they take a look at the TV, they fiddle around with it, they have the salesman show it to them, and then they buy it on Amazon.
Mm-hmm. Yeah,
they can get the same guarantee. They can get the same geek to help them out at some point if there's a problem with it. But it just spells doom for a lot of the bricks and mortar in this country. And anytime you're going to downplay or downgrade an asset like commercial real estate to that extent, it's going to have a huge impact going forward.
Yeah, and really, that's the trend, no doubt, and it's really unstoppable. And looking at the market, eventually it's going to come to reflect economic reality in America, no matter how long it's been disconnected. Don't you believe that?
Oh, correct. And, right now what we see is a dichotomy from what we are told and what we're seeing. And the average Joe is not at the point yet where he's shrugging his shoulders and trying to figure it out, but eventually that's going to impact him. For instance, we're told about the recovery. It's ongoing. More people are employed. And that part is true. But the labor participation rate has been falling, and it's down to the lowest it's been since 1978. That's 2238. It's over 35 years ago. There's something wrong with this picture. How do we still have 1 out of 7 Americans on food stamps? What's wrong with this picture? We're not being told the truth. Every once in a while I visit John Williams' website, shadowstats.com, and this fellow is an economist, and he shows you how the government has changed the way the CPI is presented, and it's actually not giving us an accurate view. We're looking at official government figures of 2.5% a year approximately, and it's actually more than double that.
No doubt. Yeah. Inflation. Look at the way food prices have gone up, Alan. This year, so far, They're up 20%. Now, part of that's due to the drought in California and the western states, but not all of it. And energy prices way, way up, especially in the past month alone, the price of gasoline. And that's just consumer price inflation. That doesn't include, the increase in the size of the money supply, which is true inflation. So
yeah, and this is another thing that worries me down the road. When you're increasing the money supply by that much, when you have the silent inflation, when you have all of this debt building up in society, how does this debt get paid off? It probably gets paid off with dollars that have been cheapened by inflation over time. So I'm very worried. It's not going to be an exact replay of what we had in the 70s, but I think logically you're going to see a bout of higher inflation somewhere along the line for a number of years, so that not only people, but the government can pay off debt with cheaper dollars.
No doubt. And we will talk more about this up next on the Financial Survival Network.
FSN Radio.
Urgent alert. Ex-Secret Service agent claims it's worse than people know. One of Obama's former Secret Service agents recently smelled a rat. What he discovered inside our government was so devastating, he only saw one option. He quit. What's worse, he fears what he found could affect your job, your neighborhood, and most importantly, your family, very soon. It's worse than people know, he said in a recent interview, and I'm not trying to scare you either. We too share his concerns. This is why we've devoted the better part of 3 years collecting solutions for nearly all problems created by intrusive governments, and we've succeeded. Go to hiddensecrets1.info to check out all the details. Our panel of insiders have devised a legal but sneaky set of solutions to help you reclaim your privacy from the NSA, opt out of Obamacare, and make a bundle from little-known investments and small business opportunities. Simply visit hiddensecrets1.info. That's Hidden Secrets, the number 1.info.
The Financial Survival Network. It's all about what's next.
And we are back. We're talking with Alan Newman of Crosscurrents.net on the Financial Survival Network. So, Alan, thinking about this, what do you do? Do you think real estate is the way to go? Or do you do residential real estate, multifamily apartments because people are losing their homes? What's your perspective? You do gold and silver, precious metals?
You don't buy shopping malls, that's for sure.
Yeah, that looks like a bad idea, doesn't it?
Yeah, you do have certain successful companies like Simon Property Group. Their stock symbol is SPG. I probably would not be afraid to buy their stock, but I'm not going to. I'm shying away from real estate. I already have a significant amount of money in real estate that I wish we had gotten out of a few years ago. Obviously, it's down in value, but I guess you have to be invested in several different areas. You can't just put all your eggs in one basket. Residential real estate, I don't know. I'm not a big fan of that either. You did mention gold and silver. I don't analyze the silver market that much. I do know it tags along with gold to a significant degree, so I'm happy on that score because I am absolutely head over heels in love with gold and have been since September 11, 2001. I believe the world changed on that day. I came to that realization quite suddenly, and I think it was the very next issue of Crosscurrents where I said, that's it, folks. We're at a super bull market for gold. It's going to last for a long time. Gold is going to go up just incredibly. And even though we're up to close to $1,400 an ounce or $1,300 an ounce from about a level of $250 or $260 an ounce, I think it's got a long way to go. I've done a lot of work on the Dow-Gold relationship. Going back to 1975, that relationship is currently about 12.5 to 1. In other words, you just take the Dow and you divide it by the price of gold, and you come up with that ratio. So the Dow is now 12.5 times what gold is. I think we could come down to the average ratio where we were between 1975 and 1994, which were relatively docile times, I think, that could resemble the future. And that was 5.67. That Dow-Gold ratio. That would bring you up to close to $2,900 an ounce for gold, given the Dow at the same price. We could also come down to 5 to 1, which is my long-term target. That would get gold up to close to $3,300 an ounce. I do think those targets will happen.
You know, it's really interesting, Alan, that you're a stock market guy, but you're valuing the market in terms of gold, which very few true stock market analysts ever take the time or the bother to do. I just find that really interesting.
If you don't believe that stocks are fairly valued, that they're greatly overvalued, you have to have something to balance it against. So I like the idea of gold because it has been a currency, in fact, for thousands of years, and there's no reason to assume it won't be in the future. It's the currency of last resort. If there are wars in the future, and I unfortunately believe the odds...
When, not if, when.
Yeah, right. And I believe the odds for those, for wars happening in the future are rising.
We're on the war cycle, 25.02 years, according to Martin Armstrong. And that number is uncannily correct. Go back to Vietnam, World War II. I mean, it just carries through. I mean, it's just awful,
I would like to tell your listeners, if they haven't heard your Martin Armstrong interview, they should listen to it right after this one.
Hey, thanks for the plug on that.
Oh, that was great. That
pretty
was
proud of it.
A terrific interview.
Yeah. Yep. And interestingly enough, I mean, I'm a dollar bear. I think it's headed for oblivion, and he's totally contrary to that, mainly because, and there's a certain perverse logic to his theory, is that there's not another dog in the race. I mean, you know, China can go do all these bilateral agreements all you like, but they went and they had a bond sale recently, and nobody came to buy their bonds because nobody trusts them, because their accounting, as bad as our accounting is, their accounting is fraudulent. So, hey, this is it.
Well, for the foreseeable future, I think he's right. There is no other dog in the race. What the heck is going to replace the dollar at this point?
Right, that's the qualifier. If you're going 5
or 10 or 15 years down the road, I don't think any of us
exactly.
can imagine the dollar not being the reserve currency, but that could happen. I mean, societies don't live forever. Civilizations don't live forever.
And we're doing our best to self-immolate here, right,
exactly.
Alan?
Yes.
I mean, that's what we're doing. Like
we certainly are.
All the problems you outlined with excessive money printing, growing entitlements and loans and debt beyond the rate of GDP. And GDP is a crock of, it's just ridiculous, the whole measure of GDP. It's not really accurate, but a story for another day. But let's just assume that it is. Hey, but, all these problems and, the The world's in a major depression. That's the fact of the matter.
We don't see it yet, but it is there. And unfortunately, I do think it's coming. Again, it all goes back to leverage. It all goes back to debt. And again, you mentioned I'm a stock market guy. I am, and I don't see stocks being fairly valued. I see the market driven by momentum traders. It's all about Netflix. It's all about Amazon. It's all about Tesla. Until recently, where these stocks all seem to be topping. And it's all about high-frequency trading, which accounts for at least half the trading.
Yeah.
People are slowly pulling out of the stock market. One of the major reasons why is that baby boomers are at that age where they want to pull money out of the market. They want to keep it safer, shall we say. So we're not going back to those grand old times where 55% of the nest egg was invested in stocks. Well, 55% of Americans were invested in stocks. It's going to remain well below that for years to come.
Hey, so aside from buying gold, any particular strategies you have using options or selling the market short? It's always dangerous to sell the market short because you don't know when this crash is going to come, but you could be using options to do it, right?
Well, I'm not an options guy anymore. I used to be when I was firmly ensconced behind the computer monitor in the office years ago. I used to do a lot of trading options. It's not worth my while now. I'd rather be on the golf course, obviously, at my age. However, in terms of gold, gold stocks are undervalued. They have been slaughtered since gold put in the August 2011 peak in price, and I think they now present excellent value, particularly the juniors. I do have positions in Newman, symbol NEM. I do have positions in Gold Corp, GG. There are a few others I like, but they're speculative, and I don't even want to mention them here. But Gold Corp and Newman, I think, are terrific buys here. And if you want to buy the juniors, there's an ETF, the GDXJ.
Sure. Know it well.
Yeah. Now, again, these are down significantly in value, and there's no guarantee as to when they're going to turn and rise. But if we can break through, let's say, $14.20 an ounce for gold, I think that's going to turn a lot of heads. And I do think we're going to be back to the old highs, which are just over $1,900 an ounce. Maybe not this year, but sometime next year. And again, that's probably going to be news-oriented. It may have to do with an imminent war threat somewhere around the globe. It may have to do with the news of a major financial institution in trouble.
Yeah.
In terms of currency, I like gold.
Yeah, well, it is a currency in the final analysis. Gold is true money. It has an intrinsic value. If you listen to this show, all the things. It's durable, it's divisible, it's portable, all the good stuff. It's a medium of exchange. Not so much anymore, but it could easily become one at a moment's notice. Just wait till your ATM card doesn't work. Wait till you go to the supermarket, your credit card doesn't work, and hey, just wait, and all of a sudden gold will be money before you even knew it, right?
Correct. Exactly.
So you gotta love it, and there's so much more. So hey, tell us about your newsletter, how we get it, how we find out more about you.
Well, I've been around for 25 years. The website is www.cross-currents.net, not .com, .net. And don't forget the hyphen between the word cross and the word currents. We have a free portion of the website. We have a big feature called Pictures of a Stock Market Mania that's generally changed about every 3 to 4 months. It used to be once a month, but it's just too much work for this old man to do anymore. But the newsletter, there is a free trial button that your listeners can tap on and get a free trial. It amounts to a 3-month subscription to the newsletter, and they can find out the kind of work they do. And if they like us, great. If they don't, well, we're not for everybody, that's for sure.
Hey, well, nothing ventured, nothing lost.
Exactly.
Alan, we'll have a link to your site in the show notes to this interview on financialsurvivalnetwork.com. Don't forget, sign up for our newsletter. Got a good one coming out probably this weekend if I can sit down and concentrate long enough, and just sign up. It's free. Alan, it's great catching up with you again. It's been too long.
Kerry, thanks very much for inviting me back on. Always enjoy speaking with you.
Likewise.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.